India reported a dismal 5.4% GDP growth in the second quarter of FY25. The latest GDP figures tell a sobering story. Growth has now declined for the third consecutive quarter. So what's happening to India's growth story in FY25? In Q2 of FY25, GDP growth came in at just 5.4%. That's the lowest in nearly 2 years and a sharp drop from 6.7% in Q1. Even more shocking? Well, it's a far cry from the 8.1% growth that we saw during the same period last year. Economists had anticipated a slight slowdown, but this sharp decline caught everyone off guard. These figures are disappointing because as recent as RBI's last monetary policy, Governor Shaktikanta Das was confident of a 7% growth before RBI brought it down to 6.8%.
Real GDP growth for 24-25 is projected at 7.2%, with Q2 at 7%, Q3 at 7.4% and Q4 7.4%.
To understand this slowdown, let's examine the 4 key engines of growth. 3 of them, that is private consumption, private investment and exports, are sputtering. Private consumption has cooled, investment is down and exports remain weak due to global headwinds. Middle class and urban private consumption has taken a hit. This could mainly be because of high inflation or high borrowing rates. Only government spending has grown, but even that is much lower than last year's levels in the first half. On the industrial front, manufacturing has taken a hit, driven by slowing urban demand and poor exports. Manufacturing recorded only 2.2% growth in Q2. Mining and power generation have underperformed due to an unusually wet monsoon, further dampening growth. The only promising sector has been agriculture, which has shown consistent growth. Amid the gloom, there's a glimmer of hope. Agriculture has emerged as a bright spot, recording a 3.5% growth in Q2, up from 2% in Q1, thanks to good rains and strong sowing. This agricultural recovery is crucial. It is expected to ease food inflation, giving the Reserve Bank of India room to lower interest rates. Moreover, improved rural demand and consumption could help balance out some of the urban slowdown. State government capital expenditure might also pick up, offering further support. But challenges remain formidable. Urban consumption has slowed significantly, with no immediate signs of recovery. Exports continue to struggle as the global economy slows and trade tensions rise. A weakening rupee threatens to fuel inflationary pressures, while private sector capital expenditure shows little sign of revival. Compounding this is the financial strain on the state governments, delaying their spending recovery. Economists are revisiting their expectations. MK Research has cut its FY25 growth forecast to 6%, down from 6.5%. CRISIL has lowered its estimate to 6.8%. To meet the government's budgeted target of 10.5% nominal GDP growth, the economy needs to grow by over 12% in the second half. Given the current headwinds, that seems increasingly unlikely. India's growth story is far from over, but the current slowdown signals the need for recalibration. With rural demand as a silver lining and global uncertainties looming large, FY25 could be a defining year. The question is, how will policymakers and businesses respond? For more news and updates, keep watching Live Mint.